to do the second part of the blue project, and then the theory behind the second part of the blue project. I have to leave. I have an appointment after class today. Wednesday, I've had an extra review session, and I'll do that again. I have a meeting downtown after class on Wednesday, but I'll come back to the office. So I may not be able to have that review session until about 4 o'clock. Okay, but I will do that on Wednesday. Of course, on Thursday we have the exam. And Thursday at the beginning of class, the project is due. If you haven't read the announcement I made, the last exam on Thursday at 10 a.m. will be 100% on the new material. I felt that with the compressed nature of the semester and the project due, it would probably be unfair to ask you to go back and review everything. Okay? So it's only on for now my words and my written statements. Okay? You missed a good discussion at the beginning of class. Okay, let's think of the takeaways from class on Thursday. First, we made the case that everyone should hold a well-diversified portfolio. What was the rationale for that? The rationale is that unless you have inside information, there's no cost for holding a well-diversified portfolio in terms of expected return. The expected return of a portfolio is simply a weighted average of the things that go into that portfolio. Okay? There are no covariance or correlation terms. So the expected return of the portfolio is not affected by holding a well-diversified portfolio. Now, I told you, I think, how my brother tricked me into managing his portfolio. Did I tell you that story? Did I tell you that story? How he'd been trying to get me to do this for years, and I refused because you know how it is with family members. Markets go up and down. We can have the absolutely optimal portfolio, and it doesn't guarantee he's going to have a good outcome. So I just said, you know, I'll give you advice, but I'm not going to actually manage the portfolio. Then a few years ago, he had done really well at work, and he actually won a trip, which was a 10-day safari through Southern Africa, through Zimbabwe, Botswana, and South Africa. And his wife had just had a baby, and she didn't feel like she could go. So he said, look, I'm allowed to bring someone, so why don't you come? I said, okay, that's great, I'd love to do that. So we're flying over to Africa, and it's a long way to fly to South Africa. We're flying from JFK to New York, and we've flown all night. We stopped in Dakar, in Senegal, so we crossed the Atlantic, we landed in Africa, and the pilot comes on and says, we're stopping to refuel, we're almost halfway. So, it's a long trip. So we're relaxing, enjoying some good conversation. And I said to him, you know, this is an expensive trip. This was our first class trip. And you're going to have to pay taxes on this. So at least let me pay your taxes on the trip. And he said, you know, brother, you've done a lot for me. It's mine. I got it all. really, let me pay the taxes on it. He said, no, don't worry, I've got you covered. He said, look, I'll tell you what, if you want to do something, why don't you manage my portfolio? So, in my state of extreme fatigue, we were flying all night, and they did have free adult refreshing beverages. I acceded to his request and agreed to manage his portfolio. So we go on, we have the trip. It's an amazing trip. Africa is a really, really interesting place. And it's actually one of the markets, but I think with the greatest investing potential right now because of dramatically growing middle classes. In not just countries like South Africa. South Africa has actually had a rough patch lately. But I think there are a lot of opportunities in Africa for investing. But one thing that seems strange about the trip was we had to bring a suit because in the last night, the CEO of the company was actually flying over from the States to give a talk. And I said, okay. So last night, we had this wonderful trip. We go to this reception. The CEO says, well, I hope you had a wonderful trip. I saw the itinerary. I would have liked to have done it. I couldn't do it. And I mean, I'm sorry to have you guys get dressed up in a suit. But you know the only reason why we're doing this so we can call this whole trip a business meeting. We don't have to run this thing through your W-2 and have you pay taxes. So I looked at my brother and I said, did you know this? He goes, I didn't know anything. But anyway, when I started managing his portfolio, the first thing I explained to him was that he was not sufficiently diversified. He had too many bets on and he had a reason for them all. But I explained to him that he was making a mistake by not diversifying more. And he said, that doesn't make any sense. Because if I diversify more, I'm less likely to get rich. Is that a true statement? Could be. Think about this carefully. He said, by diversifying more, I would be less likely to get rich. True or false? It's actually true. Well, he's got some specific risk in his portfolio, okay? And modern finance says that you don't get compensated in terms of expected return for taking on firm-specific risk. But with more firm-specific risk, you do have the potential for a higher level of return. Not a higher expected return, but a higher return is possible. So I said, you're absolutely right. You are less likely to get rich. But then what's my response?
Get poor.
You're also much less likely to get poor. And I said, I've got a real interest in that not happening because every time you've been in a tough financial spot, you always hit me up for a loan. So what you do by diversifying is you take the distribution that looks like this with long tails and you make it a much narrower distribution, but you don't affect the expected return. Okay? And the whole idea of risk aversion is that you care more about losing a dollar than you do about gaining a dollar because of diminishing marginal utility of wealth. That's another way of saying the concave utility function of wealth. Another way of saying that a dollar means more to you when you don't have very much money than it does when you have a lot of money. And that was an intuition that you all accepted, you all thought was perfectly reasonable. Okay? So it's perfectly rational and reasonable when you think about it to accept the fact that you are risk averse. Yet people tend to make bad decisions because they start thinking about, well, I can get rich if I do this without seeing the downside. And then a lot of people make a different type of mistake and they think, well, gee, I could lose a lot of money, so I'm not going to take any risk. And then they give away their opportunity to make any return at all. Okay? So our first takeaway from class on Wednesday and Thursday was that everyone wants to hold a well-diversified portfolio. Okay? So when we combine asset classes together, we're going to combine together well-diversified portfolios of, say, stocks and bonds, real estate, international stocks, international bonds, etc. We're not going to have firm-specific or firm-specific risk in these portfolios. Okay? Now, one of our takeaways as well on Thursday, and remember this line here, this curve, was the curve that showed what was possible simply by combining together different portfolios of debt and equity. And we got this counterintuitive result that if you started with 100% of your wealth in a debt portfolio and started to shift some of your wealth towards equities, you would actually initially reduce the risk of your portfolio while you were increasing the expected return. Okay? Totally counterintuitive. But this follows from portfolio mathematics. This follows from the fact that the variance of the portfolio depends upon the correlation between the asset classes. Okay? And if the correlation is sufficiently low, you can actually get a dramatic reduction in risk even as you're moving to a riskier asset class. And while we were doing this, of course, we're increasing the expected return. Okay, we're increasing the expected return, and then eventually we have to increase risk to have a risky portfolio with greater expected return. Okay? And then we develop this intuition for how you would actually find an optimal risky portfolio. We know that investors want to choose a risky portfolio with the highest Sharpe ratio possible. Why? Why is a high Sharpe ratio good? Because the Sharpe ratio tells you the expected return per unit of risk. The more expected return you get per unit of risk, the greater the benefit from taking risk. Okay? And then we combine that with the intuition or the result that we got on Tuesday, which was that whenever we take a risky portfolio, take any risky portfolio, take that risky portfolio right there. If I combine this portfolio with risk-free assets, the trade-off between risk and return was linear. Okay? So we can be along any capital allocation line. We can choose to invest along any capital allocation line that connects the risk-free rate with any point on this frontier. And it was a simple geometric argument that the best risky portfolio would actually be the one that was just tangent to this frontier, because that would give us the steepest, biggest Sharpe ratio. Okay? And this also allows us to reject statements like, well, if you're very risk averse because of where you are in life, you're better off holding all your risky wealth in bonds. Okay? Well, if I hold all my risky wealth in bonds, I invest along this line right here. Okay? So, and let's say I chose to be right here. Well, the thing is, I could be up here with a higher expected return and lower risk by combining risk-free assets with this risky portfolio and simply putting a substantial fraction of my wealth in risk-free assets. Okay? This was an amazing insight that was had when this, again, this resulted in a Nobel Prize in economics. This is economics you can actually do. Okay? And one of the takeaways of this would be the only way in which people differ is in terms of their level of risk aversion. And we know there are different levels of risk aversion, right? You know that. Look at your friends. You've probably got some friends that are really, really cautious and some friends that are risk takers. Okay? And you can see this in children from the time that they're born. Okay? I've got a friend who had a son, and as soon as he could stand up, when he wanted to stand up and walk, and he was crashing into walls, and he was falling and hitting his head. They were actually thinking of making him wear a helmet. Because, you know, now my daughter, on the other hand, we were actually worried because she wouldn't walk. And I took a video and took it to the pediatrician, and the pediatrician said, look, she can walk. She doesn't want to walk because she thinks she might fall down. And the first time she would take a few steps, she would take a step like this, she would take a step like this, and then with perfect control, she'd lower herself to her knees. Okay? She never fell once. So differences in risk aversion. I think they're hardwired in. Okay? It's a personality thing. Okay? So, if the only dimension on which people differ is their level of risk aversion, then we can conclude there is an optimal. The only dimension on which people differ is their level of risk aversion, then there would be an optimal risky portfolio that would be the same for everyone. Okay? I don't care if you're a 70-year-old grandmother in Iowa or a 25-year-old young aggressive investor, it would be the same optimal risky portfolio. Now, is that really the case? No, probably not, because people do differ on dimensions other than risk aversion. For example, any international students in here that are really happy to have the opportunity to study in the States, might even work here for a while, but eventually would like to return to your own country? Anyone? Okay. If I ask this question to MBA students, I typically get 20% of the class raising their hand. Okay? You've got something in your, you've got something you have to care about hedging that other people don't have, and that's changes in the relative cost of living between, due to exchange rates, in good part, between the U.S. and your country. That would affect your optimal risky portfolio. Our very complicated tax system implies that there are different investor clientele. It might make sense for me to have municipal bonds in my portfolio. It might not make sense for my brother, or vice versa. I'll tell you one thing. I put some New Jersey municipal bonds in his portfolio because he lives in New Jersey and they have very high state income taxes. Okay, I don't have any of that in my portfolio. His optimal portfolio is different from mine for tax reasons. Okay? Also, if you work for a company, you don't want to have any of that company stock in your portfolio if the value of your human capital is also tied up with that company. Now, sometimes it can make sense. For example, it's not uncommon to have an employee stock ownership plan where you're allowed to buy company stock at a discount. You have to hold it for a period of time, and then you can sell it. Okay, if it's a big enough discount, that makes sense. Okay? But there are lots of things that make this analysis not 100% correct. But it's a good starting point on how we think about the investment problem. Okay? The second point I would make is that what is this risk-free asset? As I mentioned last time, well, you can say it's T-bills, but once we take a long horizon view of this, we realize that T-bills are not necessarily risk-free if we look at their real return, because sometimes T-bills afford a positive real return, sometimes they have a negative real return. For that reason, some people say we should look at inflation index securities as a better risk-free asset. Okay? The rule of thumb, though, I think that a lot of people have arrived to that makes sense, is that rather than thinking about this allocation along the capital allocation line as being something that is so quantitative, rather put in risk-free assets the amount of money that you need to cover 6 months, 12 months of living expenses, money that you're going to need short-term to pay for a down payment on a house, to pay for your kids' tuition, whatever, and then invest the rest. And the way you invest the rest will be looking at an expected return, risk trade-off that makes sense, combining different asset classes, exactly as I've asked you to do on the group project part A. Okay? So I'm not asking you in the first part of the group project to actually draw this capital allocation line, but I think we can see conceptually how this could work, how this all fits together, okay? And you would choose the optimal point along this depending upon your indifference curve, the shape of your indifference curve. One individual might choose to be further down here, another might choose to be further up here. there a question on this? Okay. What's the important question that we've left unanswered here in this analysis? That's integral to finance. Okay, we've shown how to combine assets together to form different risk-return trade-offs. Okay? What's the important unanswered question that we haven't talked about yet? How about the risk-return trade-off for individual assets? Okay. How do we calculate the expected return for an individual asset? Okay, and what's the model that tells us how to do that? Capital asset pricing model. Okay. So, for the last major piece of material we'll cover, I want to talk about, well, how do we go from this to calculating what the expected return of an individual asset or the expected return of a portfolio of assets should be. Okay? And that comes from the capital asset pricing model. Now, recall that the capital asset pricing model tells us that the expected return of asset I minus the risk-free rate. So the excess return on an asset would be equal to the beta of that asset times the expected return on the market minus the risk-free rate. Or the risk premium on an asset is equal to the beta times the risk premium on the market, okay? Where the beta of asset I is by definition the covariance of asset I and the market divided by the variance of the market. Okay? Now, what I've asked you to do in the second part of the project is I've asked you to download data, real data, and calculate betas for individual securities. And I think it's important to know how to do that. But rather than launching into some theory, I want to show you how to do that. And then after you see how to do that, we'll talk about the theory. Yeah.
Can you repeat that?
Sure.
I can't see it.
I'm sorry. The excess return, this would be the expected return on asset I minus the risk-free rate is equal to the beta of asset I times the expected return on the market minus the risk-free rate. Okay? That'll show up in your notes in numerous places in that section. I certainly understand why you'd want to see what I wrote on the board. Okay? So, let's go ahead and calculate the beta using real data. And I'll take a company which I think may give us a strange beta, so that if you get a strange beta, you won't be shocked, and we can think about why you might get a result which is not what you would expect. Okay? Now, what are the inputs that we're going to need to calculate the beta? And the beta of the company I'm going to estimate the beta for is Newmont Mining. And its ticker is NEM. Okay? It's a gold mining company, primarily a gold mining company. Tell me, what data do I need to estimate the beta of Newmont Mining? Well, I'm going to need the expected return of the company. I'm going to need the risk-free rate. I'm going to need the return on the market, so I can calculate the expected return on the market. Okay? And then I'll be able to use those to calculate the beta. So the first thing I'm going to do is I'm going to download the return or the data about Newmont Mining so that I can calculate the returns of Newmont Mining as the first step in estimating the data. So how do I do that? Well, I put in the ticker. Okay. So I put in NEM. There's Newmont Mining Corporation. I get the quotes. And looks like Newmont is okay with much of the rest of the market. And I go into historical prices. And we're going to use monthly returns. And let's do 5 years of data. So I'll go back to 2008. Okay, does everyone see what I was doing?
Mm-hmm.
Okay, let's get the prices. Okay, now notice that this shows dividends that were paid. We certainly want to account for dividends when we calculate the beta. The adjusted close actually accounts for dividend payments. So we're going to make this real easy. Now, using 5 years of data, you don't have to copy this. We can actually download this directly to a spreadsheet. So I just go down to the bottom, download the spreadsheet. Okay, there it is. And I've got my 5 years, a little bit more than 5 years of data. Now, all I really need here is the adjusted close, which accounts for dividends. So I'll label that. I don't need the open, the high, the low, the close. I'll keep the date, and I'll get rid of this stuff. Okay, expand this out a little bit. So now I've got the prices, the adjusted closing prices at the end of each month for Newmont Mining. Okay? Now, when we calculate the beta, we don't use prices. We use returns. Okay? So how do I calculate the returns? Well, that's a straightforward thing to do. Okay? The return for the month of May is equal to the ending price minus the starting price divided by the starting price. Okay, so I've got minus 2%. Does that look right? Make sure you, there's always one group that gets this backwards. Okay, make sure you get it right. And it looks like it is right because the price went down, so I got a negative return. Okay, then I can just copy this, paste it down. Okay, now I've got the returns for Newmont. So I'll label that. So those are the Newmont returns. Now, capital asset pricing model tells us that the reason why we would expect the returns of stocks that were seemingly unrelated to have a positive correlation is because they're both operating in the same macroeconomy. Okay? And that macroeconomy determines the level of GDP growth, the level of inflation, the level of interest rate changes for all companies in that economy. And furthermore, the capital asset pricing model, as you know, says that we can use as a proxy for that macroeconomic factor the market return as a whole. So if the market as a whole goes up, it must mean that there was a good evolution in these macroeconomic factors that affected all stocks. So what I'm going to use as a proxy for the market would be a broad-based stock index. Okay? What stock index would you suggest that I use? Should I use the Dow Jones Industrial Average? What's that?
S&P 500?
Yeah, VTI. Someone's read the project. Okay. The idea is that the bigger the larger the number of stocks in the index, the more comprehensive the index, the better it's going to represent the market portfolio. So we wouldn't want to use the Dow with 30 stocks. We could use the S&P 500, but that leaves out mid caps and small caps. But to use something that tracks the Wilshire 5000, that will give us a comprehensive index of market performance. And a low-cost ETF that tracks, that you can trade, that tracks the Wilshire 5000 is ticker VTI. So we'll use VTI as our proxy for the market portfolio. Now, how am I going to get that information? I'll go back into Yahoo Finance, and for getting quotes, I'll click on VTI. Okay, and I want historic prices. Monthly. Okay, you can see that VTI pays looks like it's a quarterly dividend. So we'll download this into a spreadsheet. And it actually opens that in a new spreadsheet rather than the same spreadsheet. So this is VTI, and I'll use the adjusted close again. I'll copy this, and I'll paste it over into the original. Okay, so now I've got VTI. I want the returns as opposed to the prices. So let's calculate VTI returns. All I need to do is copy this and paste that down here. I was being sloppy. I don't have exactly the same number of observations. We can go ahead and fix that. Okay. So now I've got the return on Newmont Mining, and I've got the return on the market. Okay. Now what else do I need? Risk-free rate. This is a part that can be confusing, so I want you to be sure to understand what I do here. I ask you to use as a proxy for the risk-free rate the 3-month T-bill, and we can access the 3-month T-bill using Yahoo Finance and download it using the symbol caret IRX. Okay, you can see that's the 13-week Treasury bill.
This,
And you can see that the 13-week Treasury bill has a yield of 0.00%. That's bizarro, okay? But that's the world that we're living in right now. This world of financial repression where the Federal Reserve and, in fact, central banks around the world push down short-term rates to zero. If we get the historical prices, though, you'll quickly see, let's get the monthly. Let's go back. And you can see we don't have to go back, and again, here's the adjusted close. You can see we don't have to go back too far. In January of 2008, the 3-month T-bill had an annual yield of 1.87%. Okay? And then you can see here what the Fed did. This is when the financial crisis was heating up, and they quickly pushed that rate down to essentially zero, and it's been there ever since. So let's download this to a spreadsheet as well. Please don't crash on me. Okay, there we go. Copy this. So I'll go back into the original. Paste that in. Okay, now I've got the adjusted monthly annualized returns. This is actually an annualized return. Now, here's where it's common to make a mistake. Whenever you download data, know what the data actually is. Okay? And you can look at this and you can think, well, that's probably 4%. That's a reasonable T-bill return. What this actually is, look down here, it's 1.87, 1.78. This is actually the annualized return on the 3-month T-bill. So what we have to do is we have to turn this into a monthly return because on Newmont and the market we're using monthly returns. To calculate the beta, we're going to be using monthly returns. So we have to calculate the monthly excess return. Okay? So we have to convert this into a monthly excess return. Okay? So how do I do that? Again, this is the 3-month T-bill. Okay? And I tell you how to do this in the project. But first I want to convert this into a return that we can manipulate. So I'll say, okay, this is equal to 1 plus this, okay, divided by 100.
Just the current is divided by 100 or?
Just the rate that I downloaded.
Okay.
Because what that's doing is, it's saying 1.87, but it really means 1.87%. Okay? For some reason, it doesn't report it as 0.0187. It was reported as 1.87. Now, what's confusing here is that these numbers look so small already, you would think, why would I have to divide that by 100? Because, in fact, rates are zero. That's why they're so small. So we have 1 plus the annual return divided by 100, and then we have to convert this into a monthly return. So I'm going to raise this to the 1 divided by 12. And then I'll subtract off 1. Okay?
yeah,
And I get that strange notation. What does that mean?
Very small.
Yeah, it means essentially it's zero. Whenever you get something to the minus 0.5, it means we essentially have zero. Okay? Now if I copy this down, when we get down to the bottom here, see it actually isn't zero down here where interest rates are a little higher. And if I put in an interest rate here that was historically the average, something like, say, 3.75, you can see that we would get a monthly T-bill rate that is nowhere, is actually not close to zero. Okay? Okay, so now I have the 1 month T-bill rate. Okay? So now I have all the inputs I need to actually go ahead and calculate the beta for June month. Okay? Why don't we take a 5-minute break here? I know we're so excited to see this be done, and we'll be right back here after 4 minutes. If you have a question on the project, this is a great time to get an answer.
I don't want to see it. I hope it didn't break.